What's going on, everybody? Chris here from ProjectOption.com, and welcome back to the ultimate guide to trading vertical spreads. Now, in this video, we're going to talk about how implied volatility, or more specifically, how changes in implied volatility translates to profits and losses for the 4 vertical spread strategies. Now, this is a very important topic because it is often taught incorrectly, which is really a shame because it's such an important topic to understand. So with that said, let's get right into it. So how do changes in implied volatility play a role in the performance of vertical spreads? Now, the answer lies with extrinsic value. So implied volatility actually measures how much extrinsic value is being priced into a stock's options. Now, stocks that trade with higher levels of implied volatility have options with more extrinsic value than stocks that are trading with lower levels of implied volatility. So that lower or higher implied volatility comes from the extrinsic value in the stock's options, which comes from the amount of uncertainty the market is pricing into that stock's future price movements. Now, how does this relate to trading vertical spreads? Well, in the previous video, you learned that a vertical spread can only reach maximum profit if the extrinsic value in the spread reaches 0. Now, what does that mean? Well, that means that you want implied volatility to decrease as the stock is moving in favor of your spread. Now, that's because of the previous slide that we just talked about. Stocks that trade with higher levels of implied volatility have options with more extrinsic value, and stocks with lower levels of implied volatility have options with less extrinsic value. So if that high implied volatility stock transitions into a lower implied volatility stock, then that just means that the options on that stock are trading with less extrinsic value than they did previously. So when you're trading vertical spreads, you want a favorable directional movement combined with a decrease in implied volatility. Now, this is exactly the opposite of what many other people will tell you in terms of trading vertical spreads. So many options trading sources will tell you that buying call spreads or buying put spreads in low implied volatility environments is favorable because an increase in implied volatility will help your trade make money. And that is just not true. In fact, if you're trading a vertical spread and the stock moves in favor of your spread while implied volatility is increasing, you'll actually have less profits than you would have with a decrease in implied volatility, or if implied volatility had just stayed flat. Now, with that said, there is a time in which an increase in implied volatility will actually be a good thing for your position, and that's only if the stock price is moving against your spread. So, for example, if you buy a call spread and the stock price decreases, then an increase in implied volatility will actually dampen the losses on that spread. But if implied volatility increases and the stock is moving in favor of your spread, you'll actually be worse off. And we're going to go through some examples to show you exactly how this works and why that is. So now I'm actually going to hop over to the trading platform, and we're going to walk through some examples, and we're going to look at P&L estimations based on changes in implied volatility, and we're going to see how that impacts the performance of these vertical spreads. Alright, so for this example, we're going to look at Netflix options. Now, as of today's close, Netflix closed at $189.08. Now, for this demonstration, we're going to look at September options with 51 days until expiration. So the first trade I want to look at is the 180-200 bull call spread. So we're buying the 180 call, and then we're selling the 200 call in the September expiration cycle. Now, let's just say we entered this trade for $9.50. Now I'm going to go over to the risk profile, and as we can see here, this first dotted line is the approximate location of the long call's strike price of $180, and this second line over here is the location of the short call strike. So that in this case is 200. Now we can see there are 2 curves here. So this blue line, this flatter line, actually represents the P&L estimation of this call spread if Netflix's implied volatility were to increase by 30%. So we can see that as of now, Netflix is trading with an implied volatility of around 30.5%, but this blue flatter line is estimating the profitability of this spread if Netflix's implied volatility were to increase to 60.5%. So these two numbers in the lower left-hand corner is what we want to pay attention to here. So as you can see, we've queued up the 180, 200 long call spread or bull call spread. And as we can see here, let's say the stock price goes to $200 tomorrow. So with the stock price at $200, based on the numbers in the lower left-hand corner, we can see that if implied volatility does not change, we're expected to have a profit of around $391. However, if implied volatility increases by 30% to 60%, we're only expected to have a profit of $169. Now remember what I said earlier. A lot of people will tell you that when you buy a call spread or buy a put spread, you want implied volatility to increase because that's going to help your position. Well, as we can see here, if the stock price goes to our short call strike price of 200 and implied volatility doubles, we're going to be much worse off than we would have been if implied volatility had remained the same. Now, on the other hand, what if the stock price falls to $170? Well, if the stock price falls to $170, we're expected to be down about $640 with implied volatility unchanged at 30.5%. But if implied volatility skyrockets up to 60.5%, we're only expected to be down about $387. So when you buy a call spread or buy a put spread and the stock price moves against you, an increase in implied volatility should help lessen the losses on that trade. However, if the stock price moves in favor of your spread, you want implied volatility to decrease because that is an indication that the extrinsic value of those options is decreasing. Alright, so now I'm actually going to drop down this implied volatility number and put in negative 30.53%. Now I did that because the current implied volatility in Netflix is 30.53%, and I want to look at the estimation of profits and losses for this spread if implied volatility were to go to 0%. Now as we can see, if implied volatility goes to 0%, if the stock price is below $180, which is the long call strike of this particular call spread, then we're expected to lose $950. Now that makes sense because our maximum loss potential is $950. Now on the other hand, if the stock price goes to any price above 200, which is the short call strike price, then we're expected to have a profit of around $1,047.15. Now that's pretty much the maximum profit potential of this trade. So clearly, if the stock price moves in favor of your spread, which in this case would be an increase to a price equal to or above $200, a decrease in implied volatility will greatly help the profitability of this spread. And that's because a decrease in implied volatility just means that the extrinsic value of the options is being traded away, essentially. So if a stock is trading with 0% implied volatility, that means that the options have no extrinsic value. And if the options have no extrinsic value, that means that the market is pricing in absolute certainty in regards to where the stock price will close at the time that these options expire. Alright, well I hope those two demonstrations really helped you understand how implied volatility plays a massive part in the profitability of vertical spreads, and I also know that we only covered a long call spread example in both cases. However, the concepts that we just discussed hold true for all of the vertical spreads. When the stock price moves in favor of your vertical spread, you want a decrease in implied volatility because that means extrinsic value is decreasing. However, when the stock price moves against your vertical spread, you want an increase in implied volatility because that means the options will have more extrinsic value. Now, to recap really quickly, since vertical spreads require a decrease in extrinsic value to reach the maximum profit potential, you want implied volatility to decrease as the stock price is moving in your favor. And as we just discussed, if the stock price moves against your vertical spread, an increase in implied volatility may result in less severe losses, and that's because an increase in implied volatility is an indication that extrinsic value is increasing. Alright, well at this point you have a firm understanding of how time decay and implied volatility play a role in the profitability of the 4 vertical spread strategies, but we're not done yet. In the next video, we'll talk about how to choose an expiration cycle when trading vertical spreads. I'll see you there.